Marginal costing, question number 8. Mr. X has 2 lakhs investment in his business firm. He wants a 15% return on money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of sales. His fixed costs are 80,000 per year. Show computations to answer the following questions. So you have 3 different questions to be answered. What sales volume must be obtained to break even? So simply the break even sales should be found out. What sales volume must be obtained to get 15% return on investment? Mr. X estimates that even if he closed the doors of his business, he would incur 25,000 rupees as expenses per year. At what sales would he be better off by locking his business firm? Okay, so here is where we are going to talk about one new concept in this question. If you see, they have given you information on variable cost. They have given you the investment that is made by the businessman. They have also given the return on investment that is required by him. Okay, so one new thing that we are going to study here is that what is going to be the better off point, or what is going to be the better position, or what is the minimal sale that a person has to do, that a business firm has to do. Okay, so we can also call this as a shutdown point. Okay, so we are going to compute something called as shutdown point. So when the business is not able to do certain amount of sales, then it is better to shut down the business. Okay, so we are going to find out that sales revenue in the third requirement. This is what is going to be the critical thing that you are going to understand from this question. Remaining 2 requirements are going to be very simple without much complications. Okay, so since you have the variable cost information with you and the fixed cost information with you, we would assume the sales. Okay, we will assume sales to be some number, and from that we will try to find out the contribution, and we will try to get the PV ratio. So you can go by using that way, or you can simply say 60% is the variable cost. Then assuming 100 is going to be my sale, 40% should be the contribution. So 40% would be the PV ratio. You can also go in this way, or for your better understanding, I'm going to prepare a table kind of a thing. Okay, so I'm going to prepare a cost sheet kind of thing and put you the numbers. Okay, I'm going to explain you in numbers, or if you're like very well versed in this, you can directly go with the shortcut. Okay, because in exams, working notes, you need not be much detailed as well. Okay, so if you know the solution directly, so here if you say 60% is the variable cost, means then 40% is going to be the contribution. Okay, so 100%, assuming 100% is going to be the sale, so directly you can write down PV ratio would be 40%, because variable cost is 60%. Okay, that you can go directly. Okay, so we'll directly jump to the solution portion. So here is where I told you computation of income and cost. Okay, I told you we are going to assume a sales. Okay, so for your better clarity, I'm going to assume a sale. Assumed sale is going to be 100 rupees. Then what would be my variable cost less variable cost of 60% of sales? That's what is given in the question. Variable cost is going to be 60% of sales. So assume that and reduce. Okay, so reduce 60%. So my contribution would work out to 40, right? So when my contribution is going to be 40, what would be my PV ratio? PV ratio is going to be 40%. Contribution divided by sales into 100, that is 40 divided by 100 into 100 is going to give me 40% for my PV ratio, right? Then we will also write down one information. Fixed cost given in the question is going to be rupees 80,000 rupees. Okay, so fixed cost is already given in the question. So with these basic information, computation of break-even point in rupees is going to be very simple. Fixed cost divided by PV ratio. PV ratio I have just now found out. Fixed cost is already given in the question. So rupees 80,000 divided by 40,000 is going to give you break-even point in rupees. The first requirement of the question is solved. Very simple, without much complication. You have found out the break-even point in rupees, which is going to be 2 lakhs rupees. Okay, now So break-even point means what? No loss, no profit point. Okay, it's going to be a midpoint, no loss, no profit point. But this is not a shutdown point. If the business is going to do losses also, it can still continue doing business. Okay, but it should recover at least the minimal cost component. Okay, it should be able to recover at least the minimum cost. So what is that minimum cost? That is what we are going to see in the third requirement. Okay, so wait for it. Now we will solve the second requirement of the question. So second requirement, they have asked us to compute the sales revenue to earn a return on investment of 15%. So simply they are trying to tell us profit should be 15% of the investment. Okay, so now what and all informations I have, I know how to compute profit now. 15% on the investment. I have fixed cost component right now. Yes. So with that, I would be able to find out the contribution. Okay, so profit plus fixed cost is going to give me the contribution. So I know the value of contribution. I know the contribution in rupees right now. I also have the PV ratio in hand. Okay, so if I am going to divide that rupees contribution by the PV ratio, I can easily find out the sales number. Okay, how did this happen? Because if you recall, the formula for PV ratio is going to be equal to contribution divided by sales into 100. Right now that I have the contribution and PV ratio in my hand, simply dividing contribution by PV ratio is going to give me the sales component, right? So this is what is the idea. So I'm going to start with the first thing, which is going to be 15% return on 2 lakhs. 2 lakhs is the investment amount. Okay, the first line in the question says 2 lakhs is the investment made by the person. Okay, Mr. X has made a 2 lakhs investment, right? So 15% on 2 lakhs is the expected profit by the person. Right now he is also looking in for the fixed cost. Okay, you should add fixed cost, which is going to be 80,000 rupees. So the contribution required works out to 1,10,000 rupees. Okay, so this is one thing you should be very careful. Okay, so this is what is the computation. Okay, so adding up these two things, I'm going to get the fixed cost component, contribution required. Okay, the next thing that I'm going to do is that I'm going to simply divide this contribution by the PV ratio. I have told you what is the logic behind this, yes or no? So if I'm going to simply divide it by the PV ratio, I would be able to arrive at the sales volume required to earn a 15% return on investment. Okay, so what is the logic here? Contribution divided by sales is PV ratio. So to find out sales, it is contribution divided by PV ratio. That's what I have done here. PV ratio is computed in working note number 1, right? Now going on with the third requirement of the question. Okay, so third requirement is going to be very simple requirement. As I told you, we are going to find out the shutdown point. If you read the question, it says that Mr. X estimated that even if he closed the doors of his business, he would incur 25,000 as expenses per year. So even if he shuts down, 25,000 is going to be his flat expenses, which means it is beyond his control. Certain expenditures are going to be incurred. Okay, so that's where any expenditure which is going to be beyond your control, you cannot take that for your decision making purposes, because only expenses which are under your control, you can take it for decision purposes. Okay, so like you can plan to reduce the expenditure, or you can plan to cut down or manage that expenditure, but certain expenditures would be beyond your control, outside your control, which are unmanageable. You cannot manage those expenditures. Such kind of expenditure is this 25,000 rupees. Okay, it is going to be incurred even though if you shut down your business. Okay, so should be very careful here. My total fixed cost is going to be 80,000 rupees. Okay, as given in the first paragraph, but uncontrollable portion in that 80,000 is going to be only 25,000, which means you should earn at least the controllable portion. Okay, so that's what we are going to do here. My unavoidable or uncontrollable, without management, okay, the unmanageable expenses out of my control expenses is going to be 25,000. So avoidable cost, what is going to be the avoidable fixed cost? Simply 80,000 is the total fixed cost minus 25,000 is going to give me the avoidable cost. So 55,000 rupees Okay, out of the total fixed cost of 80,000, 55,000 rupees is within my control. I would be able to manage that expenditure. If I want, I can stop, or I can manage, or I can curtail those expenditures. Okay, such kind of expenditures is going to be 55,000. We call that as avoidable cost or manageable cost, right? So we are going to consider this alone. Okay, so when I get a sales revenue, that sales revenue should be equivalent, or that sales revenue should recover at least my avoidable expenditure. Okay, if my sales revenue is less than that, then no use in doing the sales, no use in running the business. That is what we are going to try to find out. So what would be the sales revenue that would recover this 55,000? Okay, so how do I find out the minimal sales revenue? Simply take the PV ratio. Okay, so 55% into PV ratio. What is this 55% into PV ratio? How did this suddenly jump in? Okay, so understand, we know that the break even sale should be 55,000 rupees. Okay, so we know that the fixed cost divided by PV ratio is going to be the break even point. Okay, so 55,000 is the break even, so into the PV ratio is going to give me the minimum sales required to better off. Okay, which works out to 1,37,500. Okay, this is going to be the minimal sales that should be done to recover the variable cost for doing the sales and also the fixed cost. Okay, so understand that we know 55,000 is going to be the avoidable expenditure or manageable expenditure. So when my sales revenue should recover, that is, my profit should be equal to this 55,000 means, then what should be the number? That is what I am trying to find out here. So the profit or the contribution number is going to be 55. The contribution number is going to be 55,000. So contribution into the PV ratio is going to give me the sales number again. Okay, so that's what I'm trying to find out here. Okay, so understand that sales minus variable cost would give you the contribution. Contribution minus the fixed cost is going to become 0. Okay, my contribution should be equal to this fixed cost, right? So that is what is this 55,000. I should be able to recover at least this 55,000 to so for that, how much should I sell? Okay, I should sell 1,37,500 rupees to recover at least this 55,000 after meeting my variable expenditure. Okay, so this is what you have to understand from this question. Okay, so this is going to be 55,000 divided by 40%. Okay, so why it is going to be divided by 40%? Because it should be the contribution divided by 40% is going to give you 1,37,500 rupees. Okay, so the same concept, whatever concept we took up here. Okay, so we took up the contribution is going to be 1,10,000 divided by PV ratio gave me the sales number. Same ways here, you have to do the same computation here. 55,000 should be the contribution means, then what should be the sales? Okay, so this much should be the sales. It should be 1,37,500 rupees. Okay, so this is all for the solution to question number 8. Okay, now it's time for you to write down the solution. Okay, so please take down, you can pause here and write down working note number 1. And you can pause here and write down the first and second requirement of the question. First and second requirement of the question. And you can pause here and write down the third requirement of the question. Pause here and write down third requirement of the question.